What is happening, crypto fans, and welcome back to Bitcoin Bulletin. The news cycle is absolutely exploding, and if you're not plugged in right now, you're missing out on some of the most pivotal moments shaping our financial future. We've got seismic shifts in how we get paid, groundbreaking tech integrations, and market dynamics that are rewriting the rulebook. Get ready, because we're diving deep into the stories that matter, the ones that will define the next era of digital finance. Let's get this bread. First up, we're talking about a revolution in how businesses are paying their people. Forget traditional methods. We're exploring the cutting edge of crypto payroll, a space where startups are navigating the wild ride of Bitcoin's volatility and finding stability in surprising places. This is a game changer for talent acquisition and employee satisfaction, especially in booming fintech hubs. How are companies keeping their teams happy and paid reliably amidst the crypto chaos? We've got the inside scoop. Next, we're shifting gears to a massive technological leap that could redefine digital transactions. Imagine stablecoins making their way onto new, innovative platforms and Bitcoin itself stepping up as a global payments infrastructure. This isn't just speculation. It's a strategic inflection point that could unlock entirely new possibilities for how we move value across borders. What does this mean for the future of payments and Bitcoin's role in it? You won't want to miss this. Then, we're tackling the ultimate question of value in a world grappling with inflation. Bitcoin's inherent scarcity is its superpower, and with the recent halving event, its deflationary model is stronger than ever. We're breaking down the supply equation, the analyst predictions, and what this all means for Bitcoin's fight against global inflation. Could scarcity be the key to unlocking unprecedented price appreciation? We're putting it all on the table. And finally, we're tracking a significant capital movement within the crypto ecosystem. Are the big players, the so-called whales, making a strategic pivot? We're seeing indications of a major rotation happening, with capital flowing from one major digital asset to another. What's driving this shift, and what does it signal for the broader market? We're getting into the details. Stick around, hit that subscribe button, ring the notification bell, and let's get into it. Navigating the payroll roller coaster. Bitcoin's volatility and the stablecoin solution. The world of cryptocurrency payroll is experiencing a seismic shift, with fintech startups, particularly in Asia, increasingly adopting digital currency payment solutions. This move is not just about embracing new technology. It's about providing financial empowerment in regions where traditional banking infrastructure often falls short. By offering salaries in crypto, companies are not only positioning themselves at the forefront of financial innovation, but also enabling their workforce with access to a more inclusive financial system. However, the inherent volatility of major cryptocurrencies like Bitcoin presents a significant challenge. The unpredictable price swings can directly impact the real value of an employee's paycheck, leading to potential morale issues and financial uncertainty. To mitigate this, many forward-thinking companies are implementing hybrid payroll models. These strategies cleverly blend the benefits of cryptocurrency with the stability of stablecoins, creating a more reliable and attractive compensation package. Stablecoins, pegged to stable assets like fiat currencies, are emerging as the crucial safety net in this evolving landscape. They ensure that the value of a paycheck remains consistent, shielding employees from the dramatic fluctuations that can characterize assets like Bitcoin or BNB. This stability is not only vital for employee retention and satisfaction, but also broadens a company's appeal to a more diverse global talent pool, attracting individuals who might otherwise be deterred by crypto volatility. The adoption of stablecoin-based payroll is gaining particular traction in economies facing significant financial instability, such as Argentina. In these environments, stablecoin salaries are becoming a practical necessity, offering a dependable alternative to rapidly devaluing local currencies. As the cryptocurrency ecosystem matures, the demand for integrated stablecoin payroll solutions is expected to surge. Despite these advantages, the path to implementing crypto payroll is not without its hurdles. Regulatory uncertainty remains a dominant concern, as governments worldwide grapple with establishing clear frameworks for digital assets. Navigating this complex and often rapidly changing regulatory environment can be particularly daunting for small and medium-sized enterprises eager to adopt these innovative payment methods. Furthermore, the inherent price volatility of cryptocurrencies like Bitcoin continues to be a point of apprehension for many businesses. To address this, companies are advised to diversify their payment options, strategically utilize stablecoins, and implement robust treasury management practices. These measures can help cushion the impact of market downturns and build greater confidence in crypto payroll systems. Nevertheless, the future outlook for crypto-based payments remains exceptionally positive. As blockchain technology continues to advance and more traditional financial institutions embrace digital assets, the stage is set for widespread adoption. Early adopters of crypto payroll solutions are likely to gain a significant competitive advantage in the future job market, fostering greater employee loyalty and satisfaction. The Great Resignation movement has further amplified the demand for flexible and modern compensation methods, with many workers actively seeking employers who offer crypto pay. As employee preferences evolve, the integration of crypto payroll solutions is poised to become a standard practice, leading to more engaged and retained workforces. Bitcoin's price volatility serves as a constant reminder of the dynamic nature of the crypto market. While it presents challenges, it also underscores the importance of informed decision-making and effective risk management for companies embracing this new financial frontier. By integrating stablecoins and adopting prudent financial strategies, businesses can harness the benefits of crypto payroll while mitigating potential risks, ultimately leading to a more stable and prosperous future for both the company and its employees. OneSafe is emerging as a platform designed to simplify these complexities, aiming to consolidate crypto and banking needs into a single, user-friendly interface, further paving the way for easier adoption of crypto payroll solutions. But what if stablecoins could do even more, reaching new frontiers on innovative platforms? We're about to explore a groundbreaking integration that could redefine Bitcoin's role in global payments. Tether's USD integration on RGB and Bitcoin's evolving role as a global payments layer. The cryptocurrency landscape is constantly evolving, with technological advancements paving the way for new functionalities and expanded use cases. A significant development on the horizon is the integration of Tether's USD stablecoin onto the RGB smart contract layer, a client-side validated asset issuance protocol built for Bitcoin. This move signifies a strategic inflection point, potentially unlocking new avenues for stablecoin utility and further cementing Bitcoin's position as a foundational layer for a global payments ecosystem. The RGB protocol, known for its focus on privacy and scalability through client-side validation, offers a unique environment for issuing and managing digital assets. By bringing USD, the largest stablecoin by market capitalization, onto this platform, users can anticipate a more efficient and potentially more private way to transact with a stable value asset. This integration could enable a wide range of applications, from decentralized finance, DeFi, to cross-border payments, all built upon the robust security of the Bitcoin network. Bitcoin's role in the broader financial system has long been debated, with many viewing it primarily as a store of value, often dubbed digital gold. However, developments like the Lightning Network and the potential for smart contract layers like RGB suggest a growing utility for Bitcoin as a global payments layer. The ability to anchor more complex financial instruments and stable assets onto the Bitcoin blockchain without compromising its core security principles is a critical step in realizing this potential. Tether's USD integration on RGB could be a catalyst, demonstrating the viability of such advanced use cases. This integration is particularly noteworthy given the increasing demand for stable and efficient payment solutions worldwide. In regions with unstable fiat currencies or underdeveloped financial infrastructure, stablecoins like USD offer a reliable alternative. By leveraging RGB, these stablecoins could become more accessible and versatile, facilitating peer-to-peer transactions, micropayments, and even more sophisticated financial contracts directly on or anchored to the Bitcoin network. The implications for the broader crypto market are substantial. It could lead to increased adoption of Bitcoin as a settlement layer for various digital assets and financial services. Furthermore, it may encourage further innovation on Bitcoin, attracting developers and projects looking to build scalable and privacy-preserving applications. The success of USD on RGB could serve as a blueprint for other stablecoins and digital assets seeking to leverage Bitcoin's security and decentralization. However, the technical intricacies of client-side validation and the broader ecosystem development for RGB are still in their early stages. The widespread adoption of such integrations will depend on user experience, developer tooling, and regulatory clarity surrounding these advanced applications. Nevertheless, the potential for Bitcoin to host a diverse array of financial activities, including stablecoin transactions and complex smart contracts, represents a significant evolution beyond its initial conception. As the digital asset space matures, the ability to seamlessly integrate stable value assets like USD with secure and scalable platforms built on Bitcoin will be crucial. This strategic move by Tether and the RGB protocol highlights a future where Bitcoin not only serves as a store of value, but also as the bedrock for a more efficient and inclusive global financial system, capable of supporting a wide array of digital transactions and financial instruments. But as stablecoins find new homes, Bitcoin itself is facing a different kind of scrutiny regarding its fundamental value proposition. We're diving into how Bitcoin's scarcity is positioning it against the world's inflation woes. Bitcoin's scarcity equation, a hedge against global inflation frenzy. Bitcoin's core value proposition is increasingly being defined by its unyielding scarcity, a trait that analysts believe could significantly outweigh the pressures of global inflation. With a hard-coded supply cap of 21 million coins and the recent 2024 halving event, Bitcoin's deflationary model is being amplified, effectively reducing the rate at which new coins are introduced into circulation by 50% to just 3 BTC per block. This reduction in new supply issuance is a critical factor in market projections. Analysts are closely monitoring the potential impact, with some forecasting prices could soar to $150,000, driven primarily by this supply scarcity. Others maintain a more conservative outlook, targeting $105,000, while still acknowledging the significant influence of macroeconomic risks. These projections are often rooted in historical patterns, where past halving events have preceded substantial price surges. The narrative of Bitcoin as an inflation hedge is gaining momentum, particularly as institutional adoption grows and the circulating supply remains relatively stable. This stability, coupled with an increasing rate of Bitcoin being permanently removed from circulation through lost wallets or other means, known as the burn rate, further reinforces its scarcity-driven value proposition. In an era of global monetary expansion and rising inflation, Bitcoin's fixed supply offers a stark contrast to the depreciating value of fiat currencies. Historically, Bitcoin's price action has shown a strong positive correlation with periods of reduced supply. The halvings in 2012 and 2016, for instance, were followed by significant bull runs, culminating in new all-time highs. The current halving event is expected to create a more pronounced imbalance between demand and the newly available supply, potentially driving prices upward. This dynamic is further supported by the increasing allocation of Bitcoin into institutional portfolios, where investors are actively seeking assets that can preserve wealth against inflationary pressures. On-chain metrics provide further evidence of Bitcoin's tightening supply. While the total circulating supply continues to grow, the rate of new issuance has dramatically slowed down post-halving. Combined with a consistent or increasing burn rate, these factors contribute to a net reduction in the available supply, a scenario that typically supports price appreciation. Analysts often point to these on-chain fundamentals as key drivers for Bitcoin's long-term price discovery. Despite the strong bullish case built on supply-side fundamentals, external factors continue to influence the market. Geopolitical developments, central bank monetary policies, and broader macroeconomic data remain significant variables that can impact investor sentiment and Bitcoin's price. However, many market participants argue that Bitcoin's unique, predetermined supply schedule provides a structural advantage that is increasingly valuable in an environment characterized by global monetary easing and persistent inflation. As more institutional capital flows into Bitcoin, the interplay between its inherent supply constraints and growing demand is expected to become an even more dominant factor in shaping its market trajectory. The narrative of Bitcoin as a scarce digital asset, resistant to inflation, is solidifying, positioning it as a compelling investment for those seeking to protect their wealth in the current economic climate. But while Bitcoin's scarcity is a powerful story, capital is always on the move, seeking the next big opportunity. We're now turning our attention to a significant capital shift happening between major digital assets. Bitcoin whales show signs of strategic rotation into Ethereum, signaling capital shift. A notable shift in capital allocation is emerging within the cryptocurrency ecosystem, with evidence suggesting that significant holders, often referred to as Bitcoin whales, are beginning to rotate their assets into Ethereum. This potential capital movement could signal a strategic rebalancing by large investors, driven by evolving market dynamics, technological advancements, or perceived opportunities in the second-largest cryptocurrency. Historically, Bitcoin has been the primary focus for large-scale crypto investors due to its established market presence and role as a store of value. However, Ethereum, with its ongoing upgrades, particularly the transition to a proof-of-stake consensus mechanism and the expansion of its smart contract capabilities, is increasingly attracting sophisticated capital. This rotation could indicate a growing confidence in Ethereum's ecosystem and its future potential, including its role in decentralized finance, DeFi, and non-fungible tokens, NFTs. The motivations behind such a rotation can be multifaceted. Some analysts suggest that after significant rallies in Bitcoin, large holders may seek to diversify their portfolios and capture potential upside in other major assets. Ethereum's upcoming upgrades, such as further enhancements to scalability and transaction efficiency, could be a key draw. Furthermore, the increasing utility of Ethereum as a platform for innovation in DeFi and Web3 applications might be compelling whales to reallocate capital towards assets with broader functional applications. On-chain data and market sentiment analysis are crucial for identifying these trends. While direct confirmation from whale wallet holders is rare, patterns in transaction flows, exchange deposits and withdrawals, and derivatives market activity can provide strong indicators. A sustained trend of Bitcoin being moved to exchanges for sale, coupled with increased accumulation of Ethereum, would strongly suggest such a rotation is underway. The implications of this capital shift could be significant for both Bitcoin and Ethereum. If a substantial rotation occurs, it could lead to increased selling pressure on Bitcoin, potentially tempering its price momentum, while simultaneously driving demand and price appreciation for Ethereum. This would also underscore a maturing crypto market where investors are increasingly looking beyond Bitcoin for growth opportunities and diversification. Market observers are keen to understand the underlying reasons for this potential shift. Is it a short-term tactical move, or does it represent a more profound strategic reevaluation of asset class dominance within the crypto space? The answer could have considerable influence on market sentiment and investment strategies moving forward. Moreover, the rotation could be influenced by upcoming events or developments specific to either blockchain. For instance, regulatory clarity surrounding Ethereum or the success of its network upgrades could further incentivize this capital shift. Conversely, any setbacks or unforeseen challenges could halt or reverse the trend. As the cryptocurrency market continues to evolve, the behavior of large holders like Bitcoin whales often serves as a bellwether for broader market sentiment and future trends. Observing this potential rotation into Ethereum will be critical for understanding the shifting tides of capital within the digital asset space and for anticipating the next phase of market development. So, we've seen how stablecoins are finding new utility. Bitcoin's scarcity is being tested against inflation, and now capital is on the move. But before we wrap up, let's quickly recap the biggest stories of the day. And that's a wrap on today's biggest stories. We saw how stablecoins are revolutionizing crypto payroll, how Bitcoin's scarcity is a powerful hedge against global inflation, and how major capital might be shifting towards Ethereum. Plus, we touched on exciting new integrations that could redefine Bitcoin's role as a global payments layer. Don't miss out on any of the action. Make sure you're subscribed, hit that notification bell, like this video if you found it valuable, and let us know your thoughts in the comments below. You can also follow us on all our social channels for even more real-time updates. Stay informed, stay ahead, and we'll see you in the next one.